right, so the next chapter we're going to discuss is Chapter 18, Non-Liquidating Distributions. We're passing over Chapter 17, which accounting for income taxes is really a financial accounting issue. Hopefully you learned something about that in one of your upper level accounting courses. At least I hope so. So what is a non-liquidating distribution? Well, it's a distribution that the corporation makes to a shareholder, but the corporation continues. Contrast that with a liquidating distribution. A liquidating distribution would be where the corporation ceases to continue. So that's the only difference. All right. So we've talked about the fact that corporations prefer not to make dividends because it creates a double taxation effect at both the corporation level. They were taxed on the income, and then they turn around and pay a dividend. That dividend is not deductible by the corporation and is thus also taxable to the shareholder, although it's at a reduced rate, it's still taxable. So when they talk about the double taxation effect, that's what they're talking about. And so corporations really don't want to pay a dividend, but sometimes they have to anyway. Of course, we've already discussed ways to avoid paying a dividend, and of course, one of those being, paying a salary, which is deductible to your shareholder or employee, renting property from the employee and paying rental expense, and possibly interest, maybe a loan as well. So anyway, distributions to shareholders will be taxed in one of the following ways, and it's when we're talking about distributions, it can be any kind of property. It can be cash, but it can also be other types of property. Mainly what we're going to be talking about is distributions of cash, though. And so going with that premise, although we'll talk about distributions of other property and how they're treated. So when a corporation distributes property to shareholders, it will be taxed as possibly one of three ways. It will be taxed as a dividend, and of course that's a lower rate, but it still will be taxed as a dividend to the shareholder. Part of that could be considered a return of capital as well. And so when something's designated as a return of capital, that portion of it, the return of capital, is not taxed to the shareholder. They simply reduce their basis in the stock, and if they have excess distribution over those two things, then the excess is considered a capital gain, which is again taxed, although it's taxed at a lower rate. So note, the first part is taxed to the extent it's a dividend. The middle part, return of capital, not taxed. The shareholder simply reduces their basis in the stock, and then capital gains, to the extent it's a capital gain, it is taxed. And again, you know, they can get around some of these things, distribution problems, by paying a salary, paying interest on a loan, or renting a building or equipment from the shareholder and then paying them rent. But you have to realize when you're paying this employee shareholder, the payment has to be reasonable. And any excess payment is considered a constructive dividend to the shareholder. Well, why is that a problem? Well, let's say you want to get around the whole dividend thing, and you want to pay a salary to your CEO, shareholder, officer, employee, and so you're going to pay them $750,000. And the IRS comes in, audits the corporation, looks at the shareholder officer's duties, looks at other competitors and what their CEOs are making, and their CEOs are making an average of $500,000. And so that excess of $250,000 is going to be considered a dividend to the shareholders. Well, why is that a problem? Well, you know, let's look at it from the shareholders' standpoint. It's actually not a bad thing because they were taxed at whatever their marginal tax rate was on that excess. And so they get to restate their income taxes and show that excess as a dividend from the corporation. So it's actually taxed at a lower rate. Well, so from the taxpayer standpoint, no problem. It's actually a little bit of a good thing there, right? Because they're getting taxed at a lower rate. What about the corporation? Well, that's where the problem lies, because if the IRS deems part of the payment as a constructive dividend, in this case $250,000, they've got to go back and restate their 2013 tax returns, and they are not allowed to deduct the excess, right? So they've got to restate the salary as $500,000, not $750,000, and of course they cannot deduct the excess because it's a dividend. And they're probably going to owe taxes on top of that, right? Because, you know, let's say, you know, we could have used a bigger number, right? But the tax, extra tax and interest and penalties on top might be kind of expensive. So that's why it makes a difference. That's why it matters. All right, so examples of constructive dividends: unreasonable compensation, shareholders' use of corporate assets without an arm's length payment. The shareholder gets to use the corporate jet for free. When you normally would have charged a fee to someone who's not related to you. That difference is going to be the amount of the constructive dividend. Interest paid to the shareholder on loans at excessive rates. So the shareholder loans $500,000 or $1 million or whatever the amount is, and the parties agree that the interest rate will be 12%. When the going rate is 8%, that additional 4% is going to be, in monetary terms, is going to be considered a constructive dividend. Payments made by the corporation on behalf of the shareholder. You see sometimes the corporation paying the shareholders' personal expenses. And not only is that not deductible by the corporation, it's, or not supposed to be anyway, it's certainly a constructive dividend to the shareholder. Now, one of the things they talk about is that the fact that a dividend is any distribution of property by a corporation to its shareholders out of its earnings and profits. So you got this earnings and profits account that, accounts that each corporation must establish. And so the two E&P accounts that we have to establish are current E&P and non-current E&P, or accumulated E&P, I should say. So how does that work? Well, we're here in 2016. Any E&P that the corporation accumulates during 2016 is current E&P. Let's say at the end of 2016, the corporation has $100,000 of current E&P. They pay $50,000 of dividends to their shareholders. What happens is the excess current E&P becomes part of the accumulated E&P beginning 2017. And so current E&P for 2017 starts at 0, and we go through this all over again. And so when we're doing this, we're having to, and we're not going to get into how you calculate E&P. It's, for the most part, like you would calculate income for financial purposes. But we will not get into the details of that. Note that dividends or distributions are designated as dividends in a certain order. They first come out of positive balances in the current E&P, and then if the distribution is in excess of current E&P, then you have to go and look to see if there's positive balance in the accumulated E&P. Assuming there is, then you take the distribution as a dividend out of accumulated E&P. So there's an order to this. Note that you cannot, a distribution will not be treated as a dividend to the extent that you don't have positive E&P. And we'll see this coming up. So if you don't quite understand, don't worry, you will, hopefully. So as we said, dividend distributions is to the extent there's E&P, either, well, first current and then accumulated. Anything in excess of E&P is considered a return of capital and reduces the shareholders' basis in their stock. And any excess distributions after considering what's E&P as a dividend and then what's considered a return of capital, of course, at that point, they'd have to reduce their basis in the stock down to zero, right? But that excess is going to be considered a gain on the sale or exchange of the stock. So here we go. A dividend for tax purposes is any distribution of property, cash or non-cash, made by a corporation to its shareholders out of E&P. And again, you have two different accounts, current E&P and accumulated E&P. And again, any undistributed current E&P at the end of that particular year just gets added to accumulated E&P. And again, we're not going to get into the details, but there are some differences between our taxable income and E&P, but you don't need to know how to compute E&P. So we're going to skip over this. In other words, for any problem I give you, the E&P, current and accumulated, will be given to you. Now, when trying to determine how to characterize a particular distribution, you're going to have one of four scenarios. And so that's what we're looking at here. The first scenario is that the corporation is going to distribute property to the shareholder or shareholders, and the corporation has positive current E&P and a positive accumulated E&P. And we'll look at what happens with each scenario here in a minute, but these are the four scenarios. You could have positive E&P and a negative accumulated E&P. You could have negative current E&P and positive accumulated E&P. And then last but not least, you could have both negative current E&P and negative accumulated E&P. So those are your four possible scenarios And so what happens when you have positive current E&P and positive accumulated E&P? Well, when you have both positive and current E&P, and I'll go back. When you have positive current E&P and positive accumulated E&P, what you're going to do is you're going to deem that it's paid, this distribution's paid out of current E&P up to the amount of current E&P. So let's say the corporation pays a dividend of $200,000. At the time, positive current E&P is $100,000 and accumulated E&P is $300,000. They're going to take $100,000 out of current E&P, and the excess is going to come out of accumulated E&P. And so that leaves you with the excess. You'd have current E&P, of course, of 0, and then whatever the excess is left over is in accumulated E&P. Now notice if you have a change in ownership during the year, you've got to do this pro rata allocation, but you can look at the example there in 18-4, but I don't think I ask anything on any of the problems about that. Not sure, you might just look at it and see how this pro rata allocation works. But as long as the current owner's ownership interest doesn't change or a new owner comes in, you don't have to worry about this pro rata stuff. What happens if you have positive current E&P but a negative accumulated E&P? So back to our example of a $200,000 distribution, you have positive current E&P of 100 and negative accumulated E&P of 200. To the extent you have positive current E&P, that's going to be a dividend. That's going to reduce current E&P to 0. You still have your negative accumulated E&P. One rule is you can't, by way of this distribution, add to the negative E&P account. And so you're going to have, in my example, a $100,000 dividend to the extent of current E&P. And then let's say the shareholders basis in the stock is 50. So what do you do with that $100,000 excess? Well, they're going to have a return of capital to the extent of their basis. So they reduce their basis to 0. They use up 50,000 of the excess 100,000 as a return of capital, non-taxable. They simply reduce their basis. And then the other 50,000 is considered a capital gain on the sale of their stock. What about a negative current E&P and a positive accumulated E&P? Well, here you have to look at the date of distribution, and when you have a negative current E&P and a positive accumulated E&P, you have to do a you have to prorate the negative current E&P to the distribution date and add it to the positive accumulated E&P. So let's say you had negative current E&P of $100,000 and positive of 200, and you make and of course this negative current E&P at 100,000 is at the end of the year, but you made a distribution of, let's say, 200,000 at the middle of the year. That's when your distribution's made. Essentially, what you would have to do is you'd cut that in half, that negative current E&P, to 50,000, add that to the positive accumulated E&P of 200,000. So you would have what? Basically, you would have a sum of $150,000 combined negative current E&P up to July 1 and positive accumulated E&P. And so 150,000 of the 200,000 distribution would be dividend to the shareholder. Let's say again their basis in the stock's 50, so that excess 50 is simply going to reduce their basis, and it's going to be a non-taxable return of capital to the shareholder. Well, what happens when you have negative current E&P and negative accumulated E&P? Again, you can't allow a distribution to add to your negative E&P's accounts. And so in this case, what's going to happen, again, in my example, $200,000 distribution to a shareholder, their basis is $50,000. They're not going to have any amount of that distribution counted as a dividend. To the extent of basis, they've got a return of capital, and the excess $150,000 is going to be considered a taxable gain on the sale of the stock. So that's how that works. Again, look at the examples they've given, but I've given you kind of a taste of how that works. Now, let's see an example here where you've got, we've already talked about this, but this is just some visuals for you. Now, this is a case where you have positive current E&P and a negative accumulated E&P. And so, in this case, you distribute $1 million on July 1. And so this is kind of a trick question. The entire distribution is deemed to come from current E&P and is a dividend to the shareholders, because the distribution is exactly the amount of the current E&P. What's tricky about it is the fact that it was made on July 1st, but for this scenario, that's irrelevant. Now, if you had the reverse situation where you had a negative current E&P and a positive accumulated E&P, just flip the numbers, then you would have to prorate the negative current E&P and add the prorated amount to the accumulated E&P to determine what this distribution would be considered as. So they're trying to trick you. All right, so here's the situation where you've got current E&P of $1 million and accumulated E&P at $1 million. And you have to kind of read into this. Well, current E&P at what date? Well, this would be at the end of that particular year. So at the end of the year, you have current E&P of $1 million and accumulated E&P of $1 million, current E&P of negative $1 million. And so the distribution of $1 million was made on July 1st. And so in this scenario, you make the pro rata of the current E&P. So you're going to take half of the 1 million negative current E&P and add that negative 500,000 to the accumulated E&P. So you're going to end up with $500,000. I mean, it says it's apportioned on a day basis, but usually these things are, you know, July 1st sort of deal, so it's half the year, right? So how are they going to treat the distribution of $1 million? Well, we don't know. We know that 500,000 of that is going to be a dividend to shareholders. But since we don't know their basis, we don't know how to treat the other $500,000 of the $1 million distribution. Well, it says it's treated as a dividend, but again, maybe, maybe not. All right, so hopefully with some of these examples in the book, look at each example for each scenario and read over those and make sure you understand how to treat each scenario. Now, and so again, we've been dealing with cash distributions up to now. All those scenarios we've been dealing with, it was assumed to be a cash distribution. Well, what happens if it's non-cash property? Well, you simply determine the market value of the non-cash property on the date received. If the distributed property has a liability attached to it that the shareholder assumes, they simply reduce the amount of the liability assumed when they're determining the amount that they're being distributed. So money received plus the fair market value of other property received minus any liabilities assumed by the shareholder on property received equals the amount that is distributed. Now, this can be a problem for both the corporation and the shareholder, which is why corporations and the shareholder really need to consider what type of non-cash property they distribute. For the most part, you wouldn't want to distribute appreciated property, because when the corporation makes a non-cash property distribution, they have to recognize gain, but not a loss, on distribution of the non-cash property. And so gain is recognized to the extent of the distributed property's fair market value, in excess of the tax basis of the property. So that's how you figure out the gain. You determine the fair market value of the property on the date of distribution. You subtract the tax basis of the property, and that's your gain recognized. Now note, what happens if the shareholder assumes a piece of property that has a debt that's in excess of the fair market value at the time of the distribution? Well, in that case, the IRS says you have to deem the fair market value to be the amount of the liability assumed. Certainly that would make sense in an arm's length transaction. So here, shareholder receives a property distribution from Sunny Corporation with a fair value of $200. Share assumes a $100 mortgage attached to the property. Sunny's basis in the property distributed is $100. And so Sunny reports a gain of $100, and Share recognizes a dividend of $100. Now here, this is the case where the debt assumed is more than the value of the property. So the fair value of the property distributed is $200. Share assumes a $300 mortgage. Sunny's basis in the property distributed is $100. In this case, the fair value of the property is going to be deemed the amount of the mortgage assumed by Share. So it's going to be $300. So Sunny's going to have to report a gain of $200 on that. All right. Tomorrow I'll be going over the rest of this chapter, starting with constructive dividends on page 14. But we'll stop for now because that's been kind of a long lecture.